Hello, my name is Russell Myers. Welcome to Issues Unite. I'm going to talk about asset bubbles and how the actions of the Federal Reserve lead to asset bubbles and how asset bubbles lead to um, recessions. So, I'm going to start off with a couple of definitions. What is an asset for financial purposes? Now, I'm going to leave out assets, personal assets, such as the money in your bank account, your personal home, your car, etc., because those do not lead to asset bubbles. These are not large enough to lead to an asset bubble. Uh, what is a commodity? A commodity is basically anything which you can invest in, which can be traded: gold, silver, um, oil, uh, agricultural goods. A little bit of trivia here. Do you know the only agricultural product which cannot be traded as a commodity? That would be onions. Why? Because in the 1950s, one person bought up all of the onion futures in the United States and wound up driving up the price of onions to an extreme degree, and he controlled the price of onions and collected millions of dollars that wound up in a congressional hearing, and Congress actually imposed legislation which removed onions from the commodities market. All right, so I'm going to do a bit of reading here, but first of all, let's start with the Federal Reserve. How does the Federal Reserve their actions lead to asset bubbles? Number one, by keeping interest rates low for an extended period of time, which we have had low interest rates ever since, 2009 or 2010, when after the 2008 financial crash. They dropped the they dropped the interest rate to near zero, and it's remained there. They tried to increase it a couple of times, marginally, like 0.25%, but then reverse course immediately when the stock market responded and declined. So when the Federal Reserve keeps interest rates low, what happens is that they encourage lending, including extremely risky lending. Credit use increases, debt increases. They always talk about how when interest rates low, people buy more, but that's not necessarily always true, because how much people buy depends on incomes, which can be completely separate from the interest rate. Anyway, so the more that they keep interest rates low and borrowing increases, especially from investors, which can be extremely risky lending, then the Federal Reserve has to create new currency to pump into the system. A lot of people say that the creating new currency dilutes the value of the currency, which can be true, but as yet, the United States has not seen that. Not yet. No, the problem is that they keep on inflating this bubble. This becomes a worse problem when the borrowers are not using that money, that newly printed money, to create jobs, to increase wages. It's not spread out through the general economy. It is all collected in the hands of a few people, the investor class, the 0.1% that we always that we've been talking about for many years now. Stock buybacks, companies borrowing money to buy back their own stock and inflate the price. The stock market, according to nearly every economy, is highly overleveraged and it is well above where it should be. The value of the general stock market is well above what it should be. So assets can include stocks, bonds, real estate, etc. So I'm going to do a little bit of reading from here. So, how do asset bubbles cause recessions? This is from Investopedia. All right, so I've explained some of that. All right, asset bubbles are especially devastating for individuals and businesses who invest too late. They're talking about the investment class, meaning shortly before the bubble bursts. In this regard, asset bubbles bear a similarity to Ponzi or pyramid schemes. Explain that in a minute. The inevitable collapse of asset bubbles wipes out the net worth of investors and causes exposed businesses to fail, potentially touching off a cascade of debt deflation and financial panic that can spread to other parts of the economy, resulting in a period of higher unemployment and lower production that characterizes a recession. So, especially devastating, they're talking about this. Yeah, I would say the people that wind up unemployed are the ones that actually are more devastated than the freaking investors. All right. Key takeaways. Asset bubbles exist when market prices in some sectors increase over time and trade far higher than fundamentals would suggest, such as the stock market. Expansion of the money supply and credit in an economy provides the necessary fuel for bubbles. Technological factors, incentives created by public policies, meaning subsidies, and the particular historical circumstances around a given bubble help to determine which asset classes and industries are the focus of a bubble, such as the housing crisis in 2008. Market psychology and emotions like greed and herding instincts are thought to magnify the bubble further. When bubbles eventually burst, they tend to leave economic pain in their wake, including recession and even economic depression. I'm going to leave out a lot of this. All right, when a central bank or other monetary authority expands the supply of money and credit in an economy, the new units of money always enter the economy at a specific point in time and into the hands of specific market participants, and then spread out gradually, yeah, right, as the new money changes hands in successive transactions. Over time, this causes most or all prices to adjust upward in the familiar process of price inflation, but this does not happen instantaneously to all prices. Early recipients of the new money are thus able to bid up prices for the assets and goods that they purchase before prices rise and the rest of the economy rise. So later investors buy in at higher prices. They stop earning anything from it, and they wind up owing. All right, like a snowball, an asset bubble feeds on itself. When an asset price begins rising at a rate appreciably higher than the broader market, opportunistic investors and speculators jump in and bid the price up even more. This leads to further speculation and further price increases not supported by market fundamentals. The expectation of future price appreciation in the bubble asset itself drives buyers to bid prices higher. The resulting flood of investment dollars into the asset pushes the price to even more inflated levels. All right, so eventually this has to stop. This redistribution of wealth and income from late investors to early recipients of newly created money and credit who got in on the ground floor is what makes the formation and collapse of asset price bubbles very much like a pyramid or Ponzi scheme. All right, so that's where I'm going to stop reading there, because a lot of this goes into how the market corrects itself. And we've already seen how that is not true. This is driven by greed. In 2020, we saw a collapse of demand, and yet we continued to see higher inflation, higher prices, even though there was a collapse of demand, and we saw higher and higher profits for the investor class. So supply and demand is a myth. So, as is happening now, in response to interest rates rising because of demand, which I've already disproven, the Federal Reserve usually has historically responded, as they are doing now, by increasing interest rates. In the late 70s to early 80s, Paul Volcker, infamously increased the interest rate to 20%. Now, Paul Volcker literally did not believe that this was going to cause a recession, and it absolutely did. The job market collapsed, the consumer market collapsed, the job market collapsed. We had 10% or more of unemployment, and it took years to recover. That was when our national debt first started rising, and now they're using that. They've used that increase in the national debt as a model. Interestingly, many years ago, they used to market U.S. savings bonds, treasury bonds, and they paid a much higher interest rate than they do now, because they wanted individual people to buy, say, U.S. Treasury bonds to help to pay off the national debt. And now they're keeping the return on savings bonds, Treasury bonds, very low, so they're not even trying to pay off the debt. So the goal of increasing interest rates is to destroy demand. In other words, what the Federal Reserve is doing is literally attempting to invoke a recession. No matter what, if you destroy demand, you destroy manufacturing, you destroy purchasing, and that means that you need fewer workers. And so far, this has not been working. They have to increase the interest rate to above the inflation rate. And so far, the inflation rate is still exceeding the interest rate. Now, as banks are failing and so forth, the investor class has not priced in the increase in the interest rate to the degree that they should. They are still expecting the Federal Reserve to turn around and decrease the interest rate, which Powell has made clear is not going to happen. I understand that Powell is trying to increase interest rates, and the Federal Reserve is trying to increase interest rates gradually to cause what they call a soft landing, a gradual decrease and deflation of asset bubbles. But it's not going to happen that way. At some point, the investor class, which is happening now, they are going to run out of liquidity. In other words, money that can be used for other purposes. And they're going to stop seeing a return, a profit on their investments. And eventually they are going to evacuate their positions on those investments. Right now, a lot of investments are being withdrawn from the stock market gradually. You don't see most of that. Most of the stock market is actually in decline. When you see the S&P 500, the Dow Jones, these are indexes of the top performing stocks. That's what you're seeing. But 80% of stocks are actually declining. So this is happening. And what this is causing is a lack of investment in smaller businesses. Eventually, when they're not getting dividends because of lack of consumer spending, they're going to evacuate those positions, and they're moving their investments into other assets. Precious metals, especially gold. They're investing in oil. And look at the price of oil, which has gone up. Sooner or later, what is going to happen is going to be a seemingly sudden, although it's not sudden, it's just not that visible to the general public, but we are going to see a mass movement out of the stock market when investors get the message that they are not going to continue to see these profits. So, this is how asset bubbles form. Right now, look at the price of housing. We are headed for another real estate crash. We are going to continue seeing unemployment rising, wages declining. Yes, the official unemployment rate is extremely low, but look at wages. So, this is what happens with asset bubbles. This is how they form, how the Federal Reserve leads to this happening, and it has happened over and over. I have stated many times that every recession and depression in U.S. history for the last 150 years has been caused by speculation, stock speculation especially. So, share this video, talk about these subjects. If you can afford it, please donate whatever you can to help expand this channel and my presidential campaign, and I will catch you in the next one. Thank you for watching. Have a good day.